Welcome to Getting Real with Real Estate with Danielle Kempf and Jim Kempf, St. Louis's favorite father-daughter real estate team. Your source of real estate information in the greater St. Louis area.
All right, well, here we go again. Welcome to the podcast.
Yes.
Hello there, hello there.
We got a guest with us today. Brennan, thank you for coming on board.
Happy to be here. Thanks for having me. I'm excited.
Absolutely. That's cool. Yeah, so we have Brennan Anderson with Heartland Mortgage Lending. Brennan's here today to help us talk a little bit. We've been talking about rental properties, right, for the last several shows.
Yep.
So Brennan's going to kind of help us talk about how you can finance those types of purchases.
Exactly.
So we're excited to get into that.
Dive into that.
Yeah.
But first
we got to start with a joke.
we always got to start with
I
a
was
joke.
gonna
Okay.
Tell Brennan to introduce himself, but we need a joke first. Yeah.
Yeah, and it goes in line with this, and then we can have Brennan introduce himself. So, Brennan, why did the mortgage lender go out of business?
That's a tough one. I'm not exactly sure. I'll let you give us the answer for it.
Lack of interest.
That's a good one. That is a very good one.
Oh.
Good thing that's not really the case right now.
Exactly.
Yeah, everybody says rates are so high, so they must have interest. Oh, well. Anyway. All right, so Brennan, take a couple minutes, man. Introduce yourself a little bit. Tell our audience a little bit about yourself.
Perfect. Yeah, so, my name's Brennan Anderson. I'm actually from St. Charles, Missouri. Grew up there. And, probably a big thing with me is that I grew up playing hockey since I was 5 years old. So I've always been like a team-oriented kind of guy. And I'm very competitive. So I'd like to kind of, bring that over into the mortgage industry. But I actually went to Lindenwood my freshman year of college, played hockey there. However, with being from St. Charles, Lindenwood was like 10 minutes away.
Yeah.
So I really wanted to get like the full college experience.
Okay.
And so I actually transferred to Missouri State, where I played hockey there. I was the captain of the team there, and then wanted to, figure out kind of where do I want to go with my career. And the big thing that I noticed is that I really have a strong passion for numbers. That's something that kind of just clicks with me versus, words. I'm not the greatest with that, but with numbers, I'm pretty good with numbers. So I ended up getting my degree in finance there.
Cool.
And, the next side of things where I was trying to figure out, where I wanted to go was, I have a strong interest for also helping people. That was kind of one of the big things too, is I want to have a career that I can actually help people in. And the next side of things was I wanted to get involved into real estate because I did have a passion for real estate. My cousin and uncle, they're both big real estate investors in Florida. So that's kind of, where that kind of sparked my interest was I would go down there over the summers and they would show me some of the projects that they're working on. They've been very successful with how they do it, and I was able to kind of see the ins and outs of rehabbing a home, all the different things that go into it, just to kind of get my footing inside of the real estate market and kind of what it was like there. So, I was thinking, how do I combine all three? And I was like, mortgages, that's perfect. Yeah. I got financing, I'm helping people, accomplish the American dream of purchasing a home, and then also I am involved in real estate. So that's kind of, that's awesome. How I came up with
it all meshed together.
Yeah.
That's awesome.
So, with that, that's pretty much how I got into it. And, with my history of it, I originally was working with a correspondent lender. And, one of the things that is, I think most consumers should know is being able to distinguish what type of lenders there are out there. So I ended up working for a correspondent lender at first. That's really kind of where I just got my whole footing into it. Yeah. And the thing with it is that it was a newer company, and there was no training. So it was one of those things where it's all right, you're thrown right into it, let's see how you do.
Yeah.
So I was all right, let's go. And so I ended up doing my own research on my own on how things all work. Of course you have to pass the exam to do that. Right. So I studied for that and had that passed, and then ended up just kind of doing my own research on how to be better at what I was doing, and YouTube's a big help. In all times.
You can find anything on YouTube.
Yeah, YouTube's definitely a big help. If you have any questions and you want to see how it's done, you go to YouTube.
Exactly.
So that's kind of how I got started into it, and then the thing with that company is they're no longer around anymore. They actually went under, and I was so new in the industry, I didn't really know why, they were really going under. And this was, kind of at the beginning of really COVID per se. And when rates were so low, everyone was so busy. And they didn't have the infrastructure inside to be able to get the loans done quickly. So a lot of people got very upset with that. I kind of foresaw this whole thing going downhill. I was like, all right, I gotta go to a different company because they're not going to be around too much longer. So that's when I actually switched into the mortgage broker side. And the mortgage broker side is a lot different, in my opinion, versus the regular direct lenders, correspondent lenders, and even banks. There's a lot more flexibility in what you can offer. And really, with being a broker, you can sign up with, different investors that are catered to specific situations.
Oh, cool.
So that's kind of, that was my next company that I worked for. However, with their things really kind of didn't sit too well with me, how the owner kind of worked everything. And it was really more of like an online type of lead-based company. Yeah. And for me, I kind of like the personal interaction with people. Granted, I do a lot of my.
We see you on the phone all the time.
Yeah, so I do a lot of like talking, over the phone, and I don't necessarily meet as much as I would like with the clients. Yeah. But that was part of the reason why I wanted to come into Heartland too, is because I'm able to work with more agents. I'm able to actually be face to face with some clients, and that part kind of helps solidify the impact of being able to help people get into homes.
Exactly.
So then that's how I came into Heartland. And the background on Heartland is they originally had another bank in here that the owners of Heartland were not had any relation with. They really didn't like how that bank was treating their employees and the people that they worked with. And so they eventually just kind of got rid of them, and they ended up actually closing their mortgage side of that bank. So they saw the need that we need to start our own mortgage company and be able to help the agents in the office, and then as well as really try to grow something here, because with Bob and Mark and even Norm, they love growing companies. So so that's kind of how they started with Heartland Mortgage. And
cool.
With that side of things, we're brokers as well, which really kind of sparked my interest. So when I made the transition, there was no learning curve on the system, because I was already using the same investors, same stuff for my previous broker shop that I worked with. So that's kind of a nutshell
how you got into the business.
Yeah, a nutshell of how I got into everything and how I got to Heartland. So
it's a good fit, sounds like. So let's help a lot of people. Well, that's awesome. Cool. So we like we mentioned, we the last couple podcasts we've been talking about rental properties. So I know that Heartland has some kind of specific programs that help people when they're buying rental properties, right? I guess maybe a little bit if you could kind of talk to. I guess there's some couple different avenues, right? Non-owner occupied versus owner occupied, right? That's one way of somebody doing it. It might be where somebody we've talked where. Somebody they bought their first home. It was a small little 2-bedroom, and then they outgrew it and they hold it as a rental. That's that loan's already in place. But somebody buying a rental, kind of talk us through a little bit some of the programs that are available for somebody doing that in those two scenarios. Maybe owner occupied, maybe being one, and then a non-owner occupied.
Okay, so I think probably the best thing, or the first thing that we should distinguish, would be the difference between a qualified mortgage and a non-qualified mortgage. In the mortgage world, we call them QM and non-QM. With qualified mortgages, that's going to be basically anything that is being sold back on the secondary market into mortgage-backed securities. And with the qualified mortgages, that's typically going to be something either from Fannie Mae or Freddie Mac or FHA. Really, those are going to be the main qualified mortgages. And with that, the qualified mortgages, they have more of a strict, guidelines that buyer is going to need to follow. When you start getting into non-qualified mortgages, those are going to be necessarily more property driven. It's not so much to where it's the buyer, it's going to be more property driven. Now, yes, that buyer is going to need to have some background that they can, pad that with. But really, whenever you're looking at submitting a file or a loan to underwriting, really all they're trying to do is just paint a good picture and be able to show them with the documentation of, what's going on, what you're doing, and how you're going to do it. So, with that, it really kind of depends on that buyer scenario. So for like the qualified mortgages, you have, non-owner occupied and then owner occupied. And the differences between those two are really going to kind of come down to almost that down payment.
Okay.
There are going to be like a little bit differences in some of the guidelines with them. But those, when you get into reading the guidelines, that you can honestly talk all day about that stuff. So for the sake of the podcast, I will try to keep it a little bit shorter than diving into all those guidelines there. But for qualified mortgages, you can purchase a property up to 4 units. That's the max. And then anything under that, you're pretty much good for a qualified mortgage. One of the things that probably most consumers don't realize is that if you're looking to do investment properties through Fannie Mae or Freddie Mac, even in some FHA cases, you can really only have up to 10 finance properties in your name.
Okay.
If you have once you're at 10, Fannie Mae and Freddie Mac, they cut you off. They're like, okay, you're good on the investment properties. And then if you're wanting to build that portfolio even more, that's when you're going to need to start looking into non-qualified mortgages.
Okay, that's good info.
Yeah. So with owner occupied, I guess I can start off with that one.
Yeah.
Traditionally, kind of depending on the property, FHA is going to be your better route to go.
Is that mainly because of down payment? It's
correct.
lower? Okay.
Correct. That down payment's going to be lower. And for anyone that's like first starting out to get into, investing in properties, I would recommend like doing an FHA loan on like a 2-unit, living in one of them, and then fixing up the other one and kind of doing whatever you need to do to the property to get it ready for someone to come in and live in there. And then that way you just kind of start on a small scale, and then you can get the repetition in and start working on that. Before you can blow into like something like a 4-unit that everyone needs work on, and so my best advice would be to really start small and kind of
you got to get some experience
exactly
kind of managing those.
And one of the characteristics that the non-QM side of mortgage lenders look into is your investor experience. So I mean, if you're going to start off small with like a 2-unit, that's and go through FHA because it's the least amount down, that's probably going to be the best route to go, because now you're building your experience so that when you are ready to go into like a non-qualified mortgage, you at least have some skin in the game that you can put with that profile whenever you're submitting it in to just strengthen that file overall.
Yeah, that's good info. Cool.
So. And then with non-owner occupied, that's going to be basically Fannie or Freddie for qualified mortgages. You can't do an investment property that's just FHA. It has to be owner occupied.
I got
that's one of the requirements for FHA.
And then the down payment, is that, I'm sorry to interrupt,
first.
but I was just going to say the down payment on the non-qualified or the non-owner occupied would probably be higher, I would imagine, right?
Correct. I actually have it broken down here too, because I came a little prepared. But so with Fannie Mae, if you're going to be owner occupied and it's a 1 to 2 unit, you can put down 15%.
Okay.
If it's going to be 3 to 4 unit, it's 25, and that's with owner occupied.
Okay.
And that's also Fannie Mae. Freddie Mac, if it's a 1 to 2 unit, it's still 15% down. However, for 3 to 4 unit, it's 20% down.
Wow. Okay.
So there's a little difference between the programs there.
Yeah.
I got a situation that I'm working on now to where he thought that he could only he was only going to put 20% down. However, there's some issues that we're dealing through with credit to where Freddie doesn't like that case, and so now Fannie will take it, so then he's now required to put 25% down on that property.
Okay.
So keep that credit score up is the moral of that story.
Keep that credit score up, and don't have any lates on your current mortgage.
That
is the big
thing.
thing. That's a big thing.
All right.
And then for investment properties where you're not, owner occupied or anything, if it's a 1 unit, you can get away with 15%. If it's going to be a 2 to 4 unit, it's 25. for just investment only, not
Okay.
any owner occupied there. So yeah, I mean, that pretty much kind of covers
But you're right. I mean, so like your advice to start with an owner occupied unit is really good advice, because man, you can get in there with as little as 3.5%. Right?
Yeah.
So man, what a great way to go if you can.
Yeah,
start
I
off
mean,
that way.
you know, the other thing too that could be kind of extremely beneficial is like if that, you know, property needs some work done to it, and you know, you are the agent's able to get some seller concessions to help with that closing cost.
Yeah.
You know, then that, I mean, really you're looking at 3.5, maybe even less to actually put down. So
That's a great start.
you know, and then there's also some other programs out there that, you know, you could get down payment assistance to cover some of it.
Right.
There's some lenders that will do a second mortgage to cover the down payment, and then you just bring in closing cost, and then at that point, if you can get seller concessions,
Wow.
you can almost get the property for like
For free,
almost
$0.
nothing. Yeah.
So you guys have a lot of options in the toolbox there.
Yeah. There's, I mean, and you know, the thing that I really like about the whole mortgage side of things is, you know, there's a product out there for everyone's type of specific situation.
Exactly.
So, you know, talking with someone that's well versed in all their products, that's where, you know, it's going to be extremely beneficial for that buyer, especially if you're working with like a broker, because some correspondent lenders or direct lenders, they may not have those products available in their, you know, in their arsenal that they can give out. However, with a broker, you can actually go and sign up with different investors that do offer those types of products. So definitely, if it's a sticky situation, you know, speak with whoever your lender is, but you know, don't be afraid to reach out to a broker too, because they can definitely do some things that most traditional banks and correspondent lenders couldn't do.
That's good advice. What about the somebody that wants to buy maybe a bigger property, like, you know, say 10 units or something, you know what I mean? Something like 20 units, whatever.
So
is that something that you guys are able to do as well? You have programs available for that?
So we do, and with that, you're going to start getting into non-qualified mortgages, or it's basically could be like a commercial loan.
Right.
So those are kind of like, you know, where you're going to start getting into that a lot, and depending on the investor too. I mean, you know, one of our investors, they put a cap on it at 18 units. You know, another investor that we have, they'll go all the way up to 40. You know, so it really kind of depends on your specific situation, the property situation, to figure out which investor is going to be the best suited for that loan product.
Yeah, and we were talking about this before the show, that there's so many different people out there that you can get your loan from, and like you just said, you just got to put it into that situation. You have to know your situation before you can figure out who the exact lender might be for that one, which is why the broker situation, you can go all those different routes.
Yeah, and I mean, if they have like a family friend that's a lender, you know, by all means reach out to them and, you know, kind of just get their opinion on it. And if they're like, well, you know, we can't necessarily do that type of product, then that's kind of where you can start, you know, looking online, trying to figure out, okay, where could I go that could possibly help me with this type of product. So yeah, that's kind of the big thing.
So the other thing that I'm kind of hearing is, and you spoke to it when you introduced yourself, is you like to be face to face and talking to people, right, and to be able to really sit down and drill down on their needs, right? And so those programs, knowing those programs and those needs, you're able to match them up. And you can't just do that if you're typing online to try to get your loan at Quicken or somebody like I can't say that. Sorry. Oops. But we'll bleep that out.
Yeah, bleep it out there.
I mean, so it's that relationship that you build with your clients that helps to tailor the product that they need, right, to them, to help them get to meet their goals, right?
Exactly, and you know, the thing that most people don't necessarily realize is how many layers there are to actually the whole mortgage industry. You know, whenever I was, you know, just taking like online leads, they'd just be like, well, what's your best rate? And it's like, all right, well, you know, I got a full list of rates here. How much you want to spend? Does it even make financial sense to even buy this rate? Or, you know, for your situation, are you short on cash to close to where, you know, you have a good amount of income that your debt to income ratio is fine and you're just short cash to close, so we can take a little bit of a higher rate to give you a credit. So like, you know, depending on their situation, you're really tailoring that loan to them. And like my philosophy with it is, you know, I always want to build it with you. Like I'm basically like your assistance to get through each gatekeeper that we got to get through, and I'm going to show you how we get there.
Right.
But at the end of the day, it's it's your loan. It's something that you need to be comfortable with and understand, so that you have a good knowledge base on what you're getting into and what your obligations are with that.
Right on, right.
So-
Wow, that's cool. Well, man, we could talk for hours.
Oh, yeah.
There were some other topics we were going to ask you about, but I think we're getting probably about to where we should start wrapping up. But
Sure.
would you come on again with us maybe sometime?
Oh, absolutely.
Because we were going to maybe ask you some things about like renovation financing and even hard money. You guys offer that type of stuff?
So we do have hard money too, and
So,
it's
okay.
really going to come down to that, property.
That's a whole
and then you
different.
guys can-
Yeah, that's
you-
a whole different. And we could probably talk for hours on that.
Oh yeah, that's. Whenever I went through and I was answering some questions here, I was like, man, I got 4 or 5 pages. I don't know if I can get through this.
Well, would you come on again with us?
Oh,
and do
absolutely,
another? That'd be
yeah.
awesome. We
I
would
enjoy
love
it. I love being able to educate, the public and even
Yeah,
my
perfect.
clients on, all the intricate parts to the mortgage, and just kind of giving them the guidance that they would need to have a full understanding of it.
Well, that's
Absolutely.
fantastic. Well, man, we appreciate you coming on today.
Yes.
And we'll do this again because really we do have
We
some
have
other
more questions on our
We got a
list.
lot more on our list that we need to talk about. So we'll do another show if that's all right. And folks, I mean, if you're looking to buy that first rental or that 10th rental, you owe
Or
it to
11th.
yourself, or 11th, right, or whatever number, you owe it to yourself to talk to Brennan at Heartland because he'll do a great job for you.
Yeah.
So I guess with that, if you're looking to buy some rental property, give us a call, give
We'll
Brennan
help
a
you
call.
find it. He'll help you finance it.
There you go.
Good team.
Good team,
Teamwork.
exactly.
All right. Well,
Awesome.
until the next time,
We're signing off.
we'll see you guys
Thank
later.
you.
Thanks.
Bye, guys.
You've been listening to Getting Real with Real Estate with the Kempf team. Have questions about real estate or something you'd like to discuss? Contact the Kempf team at 314-336-1926 or visit our Facebook page at facebook.com/the Kempf team. Don't want to miss any episodes? Follow us on your favorite podcast app or YouTube. The Kempf team. Real, honest real estate.